Hi, everybody, and welcome to today's chart of the day or thread of the day. It's October 4th, 2022, and today we're going to talk about credit spreads. In particular, we're going to talk about CDS. There's a lot of news going around, a lot of tweets about Credit Suisse's CDS. Credit Suisse is a big Swiss European investment bank, kind of a parallel to Goldman Sachs or Morgan Stanley, and a lot of people have been looking at this chart online and trying to understand what is the CDS, how does it work, and should we be concerned about the prevailing price for the CDS in the market. So what we did is we put together some data. In particular, we put together a notebook. Oh man. Ugh. And in that notebook, we try to answer that question. So this is that notebook in rows. It's in what we call view mode up here. I have a version of this notebook pulled in edit mode over here. You can see the differences are a lot of the kind of what we call chart junk or buttons to allow you to explore this notebook have been kind of obscured in view mode. And so let's just go through this pretty quickly and say what we did. So this notebook shows that we have an indicator called world credit stress. And in terms of how that was made, let me just pull it over here. That object is made from a map called World Credit Spread Triangulation Map, and we're taking the simple mean of a bunch of indicators. And you can see these indicators up here. Money market stress, broker-dealer stress, corporate credit stress, a bunch of different indices, which then below we try to pull out and actually look at. And so let's look at those here. It's a little cleaner. And what is this saying? Well, it's saying three things. One, this left chart is OIS floating rate agreement spread. So the spread between secured and unsecured version of financing versus similarly TED spreads. And you can see both of them are elevated, but not nearly as high as they have been in the past. And so money market conditions in the US look pretty okay. Whereas when we go over here to credit spreads, to the spreads on bonds relative to treasuries, we can see investment grades up, although still at only 100 basis points. But high yield is starting to get to the point where we should be a little bit worried, not yet in a systemic credit world problem, but elevated. So there are some stresses in the system. That's also viewable in the broker-dealer CDS, aka Goldman Sachs and Morgan Stanley, the credit default swaps for those, and just the VIX, which you can see is back up to 30, but is not yet at where it used to be. If we go over to Europe and try to ask ourselves, why is the European indicator for this a lot more bearish and more bearish recently? Well, it's because of exactly what we talked about before. The credit spreads of European banks like Credit Suisse are now at the highs relative to basically before the European credit crisis in the middle of summer 2012. And we have pretty material drawdowns in investment grade bonds, that's called iTraxx Main, and high yield bonds, that's called iTraxx Crossover. And then the index itself is now up to 500, 600 basis points. That means 5-year debt in Europe is trading at 200 basis points. High yield companies have to borrow at 800 or 8% a year, which is quite prohibitive relative to maybe 4%, 5% a couple of years ago. And then just diving in another level, same chart again in edit mode, we can go and look at who's actually gapping out the most, who's in trouble. And so here we can see in the US, it looks like Goldman and Morgan Stanley, the brokers are a little bit more wide than the big banks, Bank of America, JP Morgan, who are at about 100, but all of those are up from about 50 a year ago. So we've had a real steepening that's what we'll talk about, but not yet at the level of in the US during the financial crisis or even in the Euro crisis. So credit spreads are getting out there, but it doesn't look totally systemic yet. Now, if Credit Suisse goes under, this big Swiss bank, you can see their CDS here is now up to 320, pulling up the whole European average. We should expect to see credit spreads gap out for the rest of those banks. A lot of them have exposure to Credit Suisse, Credit Suisse's exposure to them. And if it's in a real credit liquidity event, it's going to have to delever its book. It's going to have to sell assets. That's going to increase spreads. This is just a longer view of that chart where we can kind of compare, what's going on with Credit Suisse to some of the European banks who had much, much worse conditions in 2012. This is when there was questions about, is Italy going to leave the euro? Is Spain going to leave the euro? Are the sovereigns whole? Can the banks save the sovereigns? Can the sovereigns save the banks? In actuality, the Germans kind of saved everybody. And you can see that's represented in these spreads. So the spreads are mostly around the broker-dealers and not in these big, European banks. So this was a bit of a slapdash. If you want to play around with this data, you can always click on Show Tree and see how it's constructed. That's probably more interesting for these bigger indicators where you can see, okay, they have a lot of stuff in here. How can I go check it out? So hopefully you do, and have a good day.